Hello friends, here we will discuss the exchange rate and the forex businesses. So let's start with the introduction part. Why we need to exchange the one currency with the other. Say if I ask you what is the rate for the $1 today, right? You will say, sir, it is around 78 Indian rupees. What do you mean by that? Indian rupees is the home currency for what? For Indian people. For Indian people, Indian rupees will be home currency, and for Indian people, that $1 will be the foreign currency. Okay. So what is a foreign currency? It is very easy. For Indian people, Indian rupees will be the home currency, and for Indian people, dollar will be the foreign currency. Now see, foreign exchange in simple term means any currency other than the home currency. In simple words, foreign currency means any currency other than the home currency. It also means the conversion of one currency to other for what? For trade, travel, movement of capital between the country. The need of a foreign exchange arises because the exporter would like to receive the proceeds of export in his home currency, while the importer would like to pay his imports using the home currency. Why majorly? Why? What is the main reason that we are doing the exchange of one currency with the other currency? What is the main reason? Say, importer. See, here is the importer in India. Here is the importer in India, and here is a say X. Here is a person B in the USA. Okay, say person I. So in India, if a person sends some goods, say this is the goods which is sold by a person I, say person I, to the person B in the USA. In that return, what he will say? He is the resident of the USA, so he will not hold the dollar. He is having in his account dollar. Okay, so he will prefer to send the person which is sending, which is seller in the India, will the person B will prefer to send the dollar. Okay, and vice versa. Vice versa. Say this is the USA, and here is a importer. Say person I is an importer now in India, and if a person I buy something from USA, say Apple is the iPhone which we have imported. So the Indian importer will not hold the dollar, right? But the he will having the home currency rupees, okay, in his account. That's why he will prefer to send the what? The rupees only. The importer will prefer to send rupees, but the USA person, which is in the which is the exporter now, right, is not having the medium for exchange, right? So here bank plays an important role. So bank will receive a rupee from that importer, convert to the dollar, and send to the bank of a, that is the foreign, that is the exporters bank. Okay, so basically when there is a importer, when there is a importer and there is a exporter. Okay, so when they exchange the goods, when they exchange the goods, in that return they have to give the money. Okay, and because it is in different country, it is in different country, so that's why we have to exchange the currencies. Okay, okay, so that means if you have imported something from the USA, you have to send them from what? You have to send them dollar, right? And if you have imported something from USA, instead of USA, say you have imported from China. Okay, you have imported some Chinese goods. In that return, what we need to say? We have to send the Chinese yen is the currency of China. Okay, so basically, why? What is the exchange rate and forex business? It is mainly due to the cross-border activity. Here is a say USA. Here is a say India. Okay, if you import something from USA, or either you can export something from the USA, in that return we have to give their currency. Okay, USA people will prefer to receive payment in dollar, and Indian people will prefer to receive payment only in the Indian rupees. Okay, that means to complete the cross border transaction, that means transaction between different country, right, where the exchange of one currency to other currency is required. For that purpose we are studying the exchange rates and the forex businesses. Okay, the main purpose is the international trade. Okay, now this is the introduction part, and the friends, see what is the volume, what is the volume of the transaction. Volume of that cross border transaction is around 6.6 trillion, 6.6 trillion per day. Okay, it is a 6.6 trillion per day. That means such a huge transaction is happening. It is the US dollar. Okay, so 6.6 trillion means 6.6 into 10 raised to 12. Okay, trillion is 10 raised to 12. So such US dollar, such a big volume is the forex per day. It is the per day transaction in the forex. Okay, this can be a one liner MCQ for you. Okay, so just remember the figure 6.6 trillion. Now what is the forex transaction? So as I have already stated, see, it is a contract to exchange funds in one currency against the fund in the other currency at an agreed rate. That means what? See, 1 US dollar is equal to, I write here INR 78. That means what? The person in India and the person in USA has agreed that 1 US dollar will be purchased for 78 rupees, or vice versa, 1 US dollar will be sold for the 78 Indian rupees. The agreement, that is at an agreed price, that means the price has been fixed, right? It is the exchange of one currency with other currency at an agreed price. It is simply the forex transaction. Now see, buying transaction means receiving the forex, and releasing home currency, and selling transaction means releasing forex and receiving the home currency. See here, what do you mean by buying? See, first you have to identify in a numerical what is a buying case, what is a buying case, and what is the selling case. Many people is not able to identify. That is very, very important, friends. You have to remember what is a buying case. See, when it is a buying case, you have to identify how it is a buying case. Okay, so see, if you go to a market, and you have to purchase something, suppose you have purchased a pen. Okay, so in that return you will get a pen, and in that return you will give a rupee to that seller. Okay, seller, and you are the buyer. Okay, so what happen in case of a buyer? Buyer receives the goods. That means buyer has to purchase the pen. That's why he received the pen, and he in that return he give the rupees. Okay, it is common sense example in our day-to-day life. Okay, in the same way, in case of buying, what is buying and what is the selling? When you buy something, that means the thing which you buy will come to you, So here we are dealing with the foreign currency, say dollar. If you buy foreign currency means it will come to you, right? That means inflow, of the foreign currency. Simply buying, if you buy something you will get it. Okay, and that means inflow towards you. You buy suppose a bicycle, you will get a bicycle. In that, and you have to send the rupees. Okay, in the same case, you are the buyer, and if you are purchasing the foreign currency, say dollar, that means buying means purchasing a foreign currency, and that means it will come to you. That is the inflow of the foreign currency. And in the same way, selling means if you sold something, and here you are selling the foreign currency. You are selling the foreign currency means outflow of the foreign currency. Remember, simply buying means if you are buying the foreign currency, it will reach to you. That means inflow of the foreign currency. And selling means it is going away from you. That's why it is a outflow of the foreign currency. I repeat, simply just remember, in case of buying, foreign currency will be inflow. Okay, and in case of selling, foreign currency will be outflow. Simply very easy. If you buy something, it will come to you. That is the inflow. And if you sell something, it will go away from you. That's why it is a outflow. Okay, I repeat here because the most important bit in the forex, first you have to identify whether it is a buying transaction or the selling transaction. So I repeat, in case of buy, it will you are buying something, that means foreign currency inflow, foreign currency inflow. And in case of a sell, foreign currency you are selling, so foreign currency going away from you, so it is a outflow. Okay, so inflow of foreign currency is in buying case, and outflow of the foreign currency is in selling case. So I repeat, it is the most important. In case of forex transaction, they will give us some numerical, and you have to first identify whether it is a buying case or a selling case. Okay, as a bank you have to judge. If a bank receive the foreign currency, that is the inflow of a foreign currency, then it is a buying case. If the foreign currency goes away from the bank, okay, that is a outflow of the foreign currency, then it is a selling transaction. You are buying foreign currency, you are selling foreign currency. You are buying, that's why it is inflow. You are selling, that's why it is a outflow. Okay, now what is the exchange rate? See, it is the price. What is the exchange rate? It is a price or a value at which one currency is exchanged for another currency. Exchange rate of a currency traded in the market is highly volatile. That means simply exchange rate means what? It is the price or a value at which one currency, say $1 is exchanged with what? You are exchanging with the Indian rupees, say INR 78. So one currency of a it is the price at which one currency is exchanged with the other currency. Okay, that is simply exchange rate. The rate at which it is exchanged, it is the exchange rate. Okay, so friends, simply what is the exchange rate? The forex transaction done at the rate called as the exchange rate, simply. Okay, so nothing to explain, it is very easy. Now what we have to discuss here is the exchange rate. See, $1 is equal to, say, INR is, say, 78. But after 3 seconds, if you check, $1 will be INR 78.25. That means it is a rate of a foreign exchange is very volatile. That means it is highly fluctuating almost every 3 seconds. Almost, I repeat, almost. In some book you will find 4 seconds. Okay, almost every 3 seconds the rate is changing. That means you can imagine how it is a volatile market, right? It is a highly volatile. Almost every 3 seconds the rate changes. Okay, so that is the exchange rate. Now see, we have to discuss here the theory part again. Foreign exchange market participant. So we have discussed here what is a forex. Okay, one currency is being exchanged for another. Okay, say INR 78. Okay, $1 is for 78 rupees, Indian rupees. Now we are doing the transaction at a forex transaction at a forex rate, right? And so what are the market participants who can participate in that, right? Suppose, for example, sir, I have to buy the I have to buy, suppose, $100. Can I participate and can I buy that? Yes, you can buy. So what is the system? What is the system required for that? Okay, so in that way we have to discuss nothing but the market participant who can participate in the forex. First, very simple, central bank. Obviously the central bank of each country, say RBI for India, right? Say, then you can say for America it is a Federal Reserve for the USA. So central bank of each country plays an important role in the forex. Okay, why? Because we know RBI hold the foreign currency. Okay, and it is very, very important, friends. If you have to deal in the international trade, how much foreign currency reserve your country is having, it is the most important. Okay, remember in 1991 our foreign reserve is such at a lower level that it will last around only the 7 to 10 days. Okay, that's why the government, the great Manmohan Singh was the finance minister that time, and he adopted the reforms, that is the LPG reforms. Okay, because we are having a reserve of a foreign currency only that will tolerate the international trade up to the 7 to 10 days. That means we are on the verge of getting bankrupt, and that's why we have adopted the LPG in 1991. So basic what I have to tell you, that a central bank keeps what it always have the foreign currency reserve. It always have the foreign currency reserve. Okay, and that is very important for what? For to balance the international trade. That is to balance the import export. That foreign currency reserve is very important. Okay, now see how it is important. See, suppose RBI is having a forex reserve of say $10,000. We are having very high, but for example, okay, $10,000. Okay, and suppose there is a person in USA and that want to export some goods to the India. Okay, so he will send goods, but he will first check how much the RBI is having, whether that country's central bank is having the foreign currency or not. If the person is sending the goods and the RBI is not having that sufficient reserve, how can they balance the trade? They cannot balance. Okay, if the goods are being sent for the $20,000 but we are having only $10,000, how can we balance the transaction? Okay, so in the same way, what I have to say, that central bank is very important, which plays an important role and which hold the foreign currency as a reserve to balance the trade movement, international trade. Okay, so central bank which manages the forex reserve of the country and intervene in the market, and it need arise to stabilize the value of a home currency. Okay, so another function of say RBI is, suppose $1 is equal to for 78 INR. Now if it is highly fluctuating and if it is going around 90 rupees, $1 is for 90 rupees, that means devaluing, where our rupee is devaluing against the dollar, right? So central bank has to take some decision. Okay, so that is the stabilization of the value of a home currency. Okay, so first, who can participate in the forex exchange? First, obviously central bank of each country. That is for India, it is RBI can participate. Next, simple, it is a commercial bank. Okay, so everybody cannot reach to the RBI. Okay, so we can go to our bank. Say I have account with the SBI. I will go with the SBI. That means a commercial bank, which include your private banks plus your public sector banks plus foreign banks in India. Okay, and plus we can say scheduled commercial banks. All are the commercial banks. That means who work for generating the profit. They are commercially. Okay, now see, a commercial bank does a foreign exchange transaction and hedges foreign exposure on behalf of their client, manages their own foreign exchange asset and a liability, does proprietary trading in a foreign exchange to make the profit. So what the commercial bank do, how they can participate in the foreign? See, suppose one customer is exporting goods to the USA. One customer of a bank, say SBI. So he will go to SBI and say, I am exporting goods to the USA. Say I am exporting a pen to the USA and I will receive the foreign currency as a dollar. So please you convert that and give to me. That means a person will reach to his bank. So that's why the commercial bank can participate in the forex. First, they will help their client. Second, how commercial bank can participate? See, bank itself having the forex department. You all know, right, that what the forex department do? They will buy the foreign currency and they are also selling the foreign currency, and difference in that they will earn as the profit. We have to discuss that in detail. Okay, so bank treasury department, that is called as the treasury department of the bank. They will buy foreign currency, they will sell foreign currency, and they will earn the profit. In that way, the commercial bank also can participate in the foreign exchange. Now, investment funds. Investment fund can also participate. How? See, moving funds from one currency to another using the foreign exchange market to maximize their profit and also hedging their investment. So, moving funds from one currency to other using the foreign exchange markets to maximize their profit. For example, you are having $1 and you have purchased it at a rate of 78 Indian rupees. Okay, now you are having again $1, but rate has been changed to 78. You will obviously sell, right? That means the investment fund will do in the same way. They will purchase and sell to maximize the profit. Okay, in that way also investment fund can participate in the foreign exchange deals and transaction. Now, broker, obviously almost everywhere there is broker, right? They act as a middleman between the other participant. Okay, with the advent of online trading, the role of the broker has come down. No, previously there was broker, right? There was not familiar. Everybody is not familiar with the transaction, online transaction broking, right? So there was a broker previously. Right now also there are broker. They are professionally working, right? So broker is basically a middleman acting between the participants. Okay, previously there was not a huge. Say some local cooperative bank is there. Local cooperative bank. Okay, and that bank received a check of for a clearing, say one US dollar of 1 million. Okay, and that cooperative bank is not having that facility of foreign exchange, so that will go to the SBI. Say SBI is having the cooperative bank account with the SBI, so SBI will help them. So here the cooperative bank will act as broker. Okay, intermediate person. Okay, simply there are also the forex brokers. Okay, it is simply the middleman between the participants. Now corporates. Corporate means big clients, right? Moving fund from one country to other country for the purpose of investment or a trading or speculation. So we the USA, for say example of a Facebook India, and say a Facebook of a USA. Okay, so Facebook India want to send their earning to the USA. Obviously they need to do the transaction through the rupees to dollar. Okay, so for that means one corporate can transfer from one country to another. Okay, for it may be for the purpose of investment, trade or speculation. Okay, so in this way corporate also participate in the foreign transactions. Now individual, obviously individual of a high net worth using the margin of exchange market for their investment, trade, personal or trade or travel needs. So even individual also can participate, but provided you should have a high net worth. Obviously you are dealing with the forex, you have high net worth, then only you can deal with the forex. Okay, so individual person can also be a participant in the forex if he is having the high net worth. Obviously he will exchange the one currency with the other foreign currency. Okay, and the need may be the for the purpose of investment, for the purpose of a trade or any personal purpose, or you can say for the purpose of a travel also. Okay, so individual person also can be a participant. So we have discussed here what are the foreign exchange market participants. Central bank, that is main bank RBI say for India, commercial banks, investment funds, then the forex broker, corporate and individual. Okay, these are main participant in the forex. Now what we have to discuss is the factor affecting the foreign exchange. What a factor can affect the foreign exchange? Okay, so basically that has been classified into the three. Some are fundamental factors, some are technical factor, and some are speculation. Okay, speculation means you are having a motive of earning a profit by the way of doing something wrong. Okay, so factors affecting the foreign exchange are mainly in a three category: fundamental factor, technical factor and the speculation. So let's discuss one by one. What are the fundamental reasons or fundamental factors? First, balance of the payment. Balance of payment, position of a country favorable, support the currency of that country. Means what? See, what is the balance of payment in generally? In broad way, I can say your export minus import. Generally, it is a balance of a payment. So you are exporting say for 100 rupees and you are importing for 50 rupees, just for example. So you will have a balance of a payment of 50 rupees, which is positive, right? So if your balance of payment is positive, obviously 50 rupees you are having, right? So what I have to say, the position of a country, the favorable balance of a payment, that is, it is a positive, so it will support your home currency. Okay, if you are importing for 100 rupees and you are exporting say for the 200 rupees, so minus 100 will be your balance of payment. Okay, that means your exports should be more than imports. There should be a balanced position. That is a difference is basically a balance of payment. Okay, and obviously it is very easy to say that a balance of payment support the home currency. Now economic growth rate. See, sustainable economic growth of a country will create positive impact of that currency in the market. For example, say India. If Indian growth of a GDP is high, say about a 10%, more than 10%, so obviously our Indian rupees will get stronger against the foreign currency. Okay, for example, if our GDP is declining, say it is a 3 to 4%, that's in that return what we can observe, $1 the foreign currency will become stronger, and our $1 we have to purchase at a very high, say 80 rupees, okay, or say 90 rupees. That means if the economic growth rate is strong, that means our foreign currency will having a good position, that will having a positive impact, okay. And if our growth rate is negative, that means a foreign currency we have to purchase at a high cost, okay. So obviously the economic growth rate positively support the home currency, okay. Next, fiscal or monetary policy. How fiscal and monetary policy affect? See, the impact of fiscal and monetary policy on the economy will have an effect on the currency depending on whether impact is positive or negative. So we have already discussed fiscal and monetary policy in the advanced bank management. So fiscal and monetary policy. So we know RBI announces the monetary policy quarterly, right? So it also create the impact on what, on the Indian rupees, whether it is positive or negative. If the policy is positive, that means our Indian rupees will get strong against the foreign currency. If our policy is negative, okay. So in ABM we have discussed in detail, that is in a budget, fiscal and monetary policy. There is a expansionary budget, there is a contractionary budget, right? Then there are monetary policy that we have already discussed. So here just remember, monetary policy and fiscal policy is also one of the important factor which affect the your foreign exchange rate and the transaction, okay. If it is positive, then our home currency will become stronger. If the policy is negative, then our home currency will devalued. See, in 1991 when we have adopted the LPG reform, that means we are forced to adopt that reforms, right? That means it have created the negative impact on the currency, and our value for Indian rupees got decreased, okay. So this is basically the fiscal and monetary policy, how they can impact on the forex. Next, interest rate. Higher interest rate normally attract investment to that country, as a result of which home currency tend to appreciate. Obviously, see, if interest rate on in India, say a 15% is the interest rate on a FD, okay. So person in USA will what they think, I will invest in India because I am getting very high interest rate, okay. So he will send a dollar. So against that, the investment is increasing in India, right? So our currency will get stronger. Obviously, it is very simple. It is a positive relation between interest rate and the home currency appreciation. If the interest rate is high, then obviously people will more invest, and our that attract the investment. So home currency will appreciate. That is gets stronger against the foreign currency. And next is the political factor. Political stability also support the currency and will have positive effect on the exchange rate. That means see how it is, see for example of Afghanistan, okay. How we all know in Afghanistan the Taliban is very active there, right? So nobody want to invest in Afghanistan, okay. So we know there is no political stability in Afghanistan. Say example of say Syria or say North Korea. Okay, there is a very high fluctuation in the political situations. Okay, say example of a nearest country Pakistan. What is the situation there? There is no political stability, right? So if there is political instability, people will not go and invest in that country. So they have there is a very huge effect of a political stability on the exchange rates, okay. So obviously in say for example in USA, in India, right, in USA, in Russia, there is stable government is there. If government is stable and that affect the foreign, that means people will say that in USA now say Joe Biden is the their president, so he will work for his full tenure of 4 years, say. We know there will be stable government, so we can invest in the USA. For India, we can say 5 years almost the Modi government in the power, so he will work for the 5 years definitely. So there is political stability. So these factors also are important in the foreign exchange. Okay, so what we are discussing, I come to back, we are discussing what are the factors which affect the foreign exchange. There are fundamental, technical and speculative factors that are broadly classified. First we have discussed the fundamental reasons. What are the factors? Balance of payment, economic growth, fiscal and monetary policy, interest rate and the political factor. Now second we will discuss the technical reasons. See, in the absence of any major fundamental factors affecting the market, trader generally base their trade on their chart depicting the movement of a currency. The chart show a certain pattern emerging from trading behavior of the participants over a period of a time. These patterns are used by traders to predict the movement in the market based on which they can take a trading position, and these are referred as a technical factor. So what is the technical factor? Through just reading you can come to know what is the technical factor. See, what the person do generally, they will observe the movement of a foreign currency. Okay, suppose this is the November, December and January, right? So one person can observe this is the dollar against the rupee. One person is observing that in November and December the dollar is increasing and in January it is again depreciating, because in November and December there are huge festival like Diwali, Christmas, right? So that's why people will more attractive towards the investment. Somebody can see, somebody can observe, right? So if the person is doing observation and he will think that in November and December the currency dollar will appreciate, so definitely I will purchase in October and I will sell in the November, December. Okay, so in this way he can imagine and he can work on it to prepare this different chart, different analysis, and to earn the more profit. Okay, these are the technical factors. Okay, so basically movement in the market based on the trading position, and these are referred as the technical factors. Okay, next is the speculation. Now speculation is another very easy name itself, it is a self-explanatory. Sometimes in the expectations of a major change in the fundamental of the market player may do speculative trading. That means for example, say suppose we can say in USA, if the situation in USA is not stable, government is changing or some decision they are taking, like they are planning to attack on Iraq or Iran, or say USA, USA or Russia has withdrawn their military from the Afghanistan, so definitely it will affect the Afghani currency as well as the dollar currency also. Okay, so in such a cases, considering the different situation, there is a speculation the people will do. They will analyze the market, they will analyze the situation, and to earn the profit they will buy or sell the currency. Okay, that is basically a speculation. Sometimes in the expectations of a major change in the fundamental of the market player may do speculative trading. For example, currency which is expected to be devalued by the central bank may be sold. There is a huge risk involved in the speculation, as expected event may not happen. For example, if the Indian rupee were in India, and if the RBI or government want to devalue the Indian rupee, if that news gets leaked and that a person is having the foreign currency, they will sell or buy. Okay, depending on such a big news or they are speculating something, right? There is a speculation factor. To earn the profit they can do, but there is a very high risk in the speculation. Okay, nothing to explain much more in the speculation. It is just a concept of speculation. So I repeat, what we have discussed is the factor affecting the foreign exchange. Fundamental, technical and speculation we have discussed. Fundamental factors: balance of a payment, economic growth, fiscal and monetary policy, interest rate and the political factors. Now friends, here we will stop in this video. We'll obviously continue in the discussion in the next lecture. Will be very important. In that we have to discuss the direct rate, indirect rate, and how to adjust the margin, discount, premium, right? That we are to discuss. So before that, do one thing. You can subscribe us on our YouTube. Name of the YouTube channel is Bankers Zone. You can also join our Telegram group for the CIB study. For that you can search on the Telegram @CAIIBBZ, or you can directly search CAIIB Bankers Zone. You can download the Android application from Play Store, Bankers Zone CIB for the CIB study purpose. So friends, don't forget to share. We will continue our discussion in the next lecture. Next lecture will be very important. In that we have to discuss the different concepts which are very useful for your solving the numericals. So friends, we will continue our discussion in the next video.